Your bank balance feels like money, but most of it isn't cash sitting in a vault. It's a promise. And the modern economy runs on one quiet design choice. Banks don't only store money, they create it. If that sounds like conspiracy, try this. If every customer walked into their bank tomorrow and demanded physical cash, most banks couldn't deliver it. Not because every bank is evil, but because the system was never designed for everyone to demand everything at once. That design has a name: fractional banking. And it's older than smartphones, older than credit cards, older than most people's idea of modern finance. To see where the trick began, you have to go back to a world where money was heavy. In medieval Europe, wealth often meant gold and silver, but carrying gold was dangerous. So people started storing valuables with goldsmiths, men with vaults, guards, and locks. In return, the goldsmith gave a paper receipt. I owe the bearer this amount of gold. At first, the receipt was just storage proof, but then something changed everything. People began trading the receipts instead of the gold. Because if everyone trusted the goldsmith, the paper moved like money. And that's the moment money creation was unchained from metal. Then the goldsmiths noticed a pattern that created the first banking math. Withdrawals were predictable. Not everyone showed up at once. So if a goldsmith held 1,000 coins, he could issue receipts worth 1,500 and lend the extra receipts out at interest. Profit from claims that didn't physically exist. It worked until it didn't. Because the entire trick depends on confidence. The receipts only behave like money while people believe they can be redeemed. And when confidence cracks, reality hits instantly. Bank run, panic, collapse. History didn't delete this invention, it scaled it. We replaced goldsmith receipts with bank deposits. We replaced one vault with a banking network. And we created central banks as the fire brigade. Because once panic spreads, confidence dies faster than any vault can be opened. Now here's the modern version in plain language. Most people think banks lend out your deposits, like your money sits there, and the bank uses some of it. But in the modern system, it often works the other way around. Banks create the loan first, and that loan creates a matching deposit. When you get a mortgage, the bank doesn't open a vault and hand you someone else's cash. It credits your account with new digits. Those digits are spendable, so they function as money. That's what money out of thin air really means. Deposit money appears the moment a loan is issued. So what stops banks from lending infinity? Today, the leash isn't a simple reserve percentage. In many places, reserve rules aren't the main constraint. The real constraints are capital buffers, liquidity rules, risk controls, and the interest rate environment set by the central bank. Translation: the bank asks, can we survive losses if this goes bad? And can we survive a short-term funding shock? And is this profitable at today's rates? And this design creates three predictable outcomes. 1. Inflation pressure. When credit expands faster than real production, spending power grows faster than real goods. Prices rise because claims expand. 2. A debt-shaped economy. If money is born as loans, the system rewards borrowing. When borrowing slows, the whole machine feels it. 3. Concentrated power. Banks collect interest on contract-created money. Asset owners often gain first. Workers feel higher costs first. So the next time you look at your bank balance, remember what it really is: a claim on a system built on confidence. Now here's the comment question. If money is created when loans are issued, who should control that power? Private banks, elected governments, or central banks? Write your answer below. Subscribe to Hidden Money History, because the economy isn't built on cash. It's built on confidence. And confidence is the easiest thing to lose.